Welcome to Your Financial Journey, where we discuss everything financial, leading you to your future destination. Welcome to COVID-19 Investor Update number 7. Glad you could join us. Looks like we got a big group tonight, so I'm glad you could make it. You're actually going to be in for a big treat. One of my friends, Brian Tatum, will be speaking tonight, sharing some of the information from JP Morgan and some of the thoughts they have on the current market and the economy and where we're headed. So I'll be happy to share some more information along with you as well. For those of you who are new, we have a number of disclosures that we have to share because some of the slides we move into issues that identify market or economic issues, also can be tax or sometimes legal issues, of which I am not an attorney, nor am I a CPA. But we cover items that can help you have information to figure out what you need to do next to make the most of your situation. Tonight, we're going to cover a couple of points. We're going to talk about COVID-19 and kind of update some of the issues and potential impacts. Talk briefly again about 4 phases to get back to normal and where I think we are with that. Brian Tatum from JP Morgan will be giving the market update tonight. We're going to talk about U.S. debt because I know in talking with several of you from the last week that is still a concern, so we're going to try to deal with some of those issues connected to that. What to look for in the coming weeks. Also, I've had some wonderful conversations with several of you about risk and reward, and I'm so impressed with how you've all been doing on your risk-alive scoring. And then I'm going to share 2 new links tonight. Things that can help you with your SMART goals, your life goals, and your life transition links. So I'm going to share that as well. And then finally, at the end, we will take your questions. The goal will be to be done by 6:30, but maybe a little sooner. It just kind of depends on how things go tonight. So that's the plan. So just kind of updating you, some stuff that I'm sure some of you already know. The U.S. has more than 1.1, almost 1.2 million confirmed cases of COVID-19 and about 68,900 deaths so far, a little bit more than that. 30-plus million people have been furloughed, laid off, or terminated in the last 6 weeks, putting us at a very significant unemployment rate. Unemployment is currently estimated to be somewhere between 15 and 20%, but could be greater than 20% before this recession ends. Some concerns about weakness in U.S. debt, individual debt, corporate debt, state, local, and federal debt are all growing right now. And concerned about supply chain disruptions or breakdowns in food service. Those are being highlighted, and most recently here, distributions for meat products. It was paper products, which doesn't seem to be as much of a problem now, but meat products are certainly one of the issues that they're dealing with. I think there'll be several other issues when it comes to fresh vegetables and fruits. That may be another issue down the road, but we will see how all that fits together. The federal and state governments, though, are implementing strategies for restarting the U.S. economy state by state. And here in Florida, we've actually started to see some of that put in place. And it's feeling good, although it's a little uncomfortable at times, too, as we'll probably talk a little bit more about tonight also. It's unsure how the virus is going to respond as we begin to reconnect socially. If you've been watching some of the news programs, you may have seen some charts that came out from FEMA. I actually have those charts and thought about putting those up, but I thought in light of time, I'm going to go ahead and hold off because I think that those charts really do represent some interesting information, maybe not quite as bad as I think some of it's being played on the news, but I'm not a doctor, so I can't really answer all that. But I can tell you that some of the information doesn't look quite as bad when you compare the expected line, the standard deviation lines, and how that could look. Nonetheless, we're all being very careful. Even at our office, we are carefully considering how we're going to reopen. We're still working on a part-time basis as far as hours open, and we still have only half staff right now, but we've begun talking about how we might go forward with that, especially in light of the possibility of testing. I have a small office, only 5 people. I can't imagine what a company that has 500 people or 5,000 people is struggling with to try to figure out how they can handle reopening, minimizing infections, and protecting against impacting customers or even maybe liability that could come from that. Additionally, money from the CARES Act is being distributed. As a matter of fact, we see that, I think I put it on here. Yeah, second one down. PPP round 2 has begun and may run out of money by the end of this week. They are moving along, and I think on one hand, we're like, oh, that's terrifying that they're running out of money. But really what it means is, back to the one above it, The Federal Reserve and the U.S. Treasury continue to aggressively create liquidity in the banking system to protect credit availability, velocity of money, and liquidity issues. Liability protection, as I mentioned before, is being discussed by Congress because it is a significant concern for employers and for businesses. When people come out, whether they are employees or they are customers or clients, what impacts can be an issue for them when it comes to liability. Also, as you may have heard ramped up in the last 2 weeks, some state municipal governments are requesting bailout resources, and how that's going to be impacted as Congress tries to negotiate that. As we've been saying along, the U.S. will likely go into recession in the second quarter. I really think about taking likely out of there, but I'm waiting to have that confirmed, et cetera. So we will see, but I think it's pretty likely, almost expected that's what's going to happen. And as I share with you every week, whatever we think we know today, it quickly becomes outdated. Everything is changing so rapidly. The purpose of these updates is to try to keep on top of it. And so on one hand, for me, it feels very much like staying on top of tons of information. At the same time, it's almost like waiting for water to boil, because as we look forward to the next 90 and 180 days, and maybe even the quarter after that, trying to assess what each step or action required to maximize wealth and to protect wealth simultaneously is going to look like, it's a process. And even some of the material that Brian will share tonight, I kind of looked through it, will say the same. As I've been sharing with you since week 2, I believe that the 4 phases to get back to normal, they are going to be phase 1, where the government is making it so that they say that it's okay for us to resume normal life. We see that starting to happen right now. But in reality, it's not going to be when they say it's okay. It's going to be when you and I feel it's okay. And I was talking to 2 different people today that they are looking forward to getting out, but they're not quite sure they're ready to go out yet. And so even if the state of Florida says it's great, and even if the USA says it's great, you can go out, it's only going to be when you and I decide we feel comfortable to go out. And we are definitely not out of phase 1 yet, because we're just seeing a slow turn on, like a dimmer switch being turned on. But when we get to that place where more and more people feel comfortable to go out and do something, that's when we move into phase 2. And in phase 2, it's when people feel safe to resume normal life. And that's what we're looking for, is for that place where people start to feel better about that. And as we move through phase 2, then we're going to move into phase 3, where businesses can start to operate again. And again, it'll be a slow process. A restaurant may say, we're going to open up, and like right now in Florida, they can do 25% of their capacity inside. Well, that's just turning the switch on. It's certainly not dialed up yet. And whether or not they can fill up that 25%, or when they move to 50%, et cetera. So it's going to be a combination of phase 2 and phase 3 connecting together, which we're still way down here. And then finally, when we get to phase 4, what we have is the opportunity then to see the economy functioning well, which may be 2 or 3, maybe 4 or 5 quarters down the road, as we'll talk more about tonight. So again, where we are right now is in phase 1. How many months is it going to take? It could take anywhere from 12 to 24 months, and we're going to have to process that as we go step by step. Now, as I told you tonight, Brian Tatum, who is Vice President and Client Advisor for JP Morgan, is going to be here tonight to share with us the information that he has been sharing with us. He's one of our good resources that we draw information from. I've known Brian now for several years, and he has been a real benefit to me in some of the information that we utilize. Certainly, JP Morgan is world class, and the resources they bring to the discussion really will make it a great update tonight. Some things that are different than what I've been sharing, not that they're off, they're just a different viewpoint of how things are coming together. And JP Morgan has huge amounts of resources to pull information together, and I'm so excited to have him here tonight. Brian, can you hear me?
I can. Yeah, thanks for having me.
Oh, it's my pleasure. Let me go ahead and switch over to your presentation.
So my comments, and I'll keep them relatively brief. I want to give you an update on what some of our views are on this point. A lot of the stuff kind of Frank already mentioned. But first want to spend kind of a minute talking about the virus itself, kind of where we stand, where the current trajectory may be taking us. And then talk a little bit about, the impacts to the economy, what the response has been from both the Federal Reserve and from our government, and then transition to talk a little bit more about investing, and in particular focus on some tried and true investment principles that we think are worth focusing on right now, given all the volatility that we're seeing in markets. So Frank, you can go to the first page there. That's where I want to start. And Frank already showed basically the exact information on the left side of the page, which shows number of confirmed cases, number of fatalities. If you do the rough math there, that's a mortality rate of between 5 and 6%. We know that's not the true mortality rate. Nobody knows what the actual mortality rate is if you factor in all of the asymptomatic cases, plus all of the cases where people have symptoms, but they just go and report it. People that weren't able to get tested, or people that just don't ever make the numbers. Our view internally is if we had to pick a round number, what the mortality rate might end up being, we would pick 1%. That doesn't mean that's the right number. There's a lot of unknowns. If you use that 1% based on the fatalities that we've seen, that would mean about 7 million people. That would imply about 7 million cases as of a couple of weeks ago. The people that fall victim to this virus, it typically takes 3 weeks or so. So if it is about a 1% fatality rate, that would mean 7 million cases, 3 weeks ago. And I say that because that's about 2% of the population. When Frank's talking about, the 4 phases and when do we get to phase 4, we're going to wait for us to develop herd immunity by everyone getting the virus. At this stage, it's going to take a long time. At this point, 2% of the population or something like that, based on that back of the envelope math, has had the virus. And maybe it's different. Maybe it's 5% or so, but we still have a long way to go before we basically develop herd immunity without a vaccine. Obviously, a vaccine is the other thing that could get us to where we entirely stop the spread. There's a lot of talk about the potential timeline on a vaccine. I can tell you, there's hope that we could get something this year. But I will tell you internally, our base case is that it's a next year thing, and that's even being relatively optimistic. Even next year, a year from today, would be reasonably optimistic. And not only that, once we get a vaccine, we have to distribute it. We have to get people vaccinated, which even that could be a challenge. The way you typically vaccinate a population is by vaccinating children. However, you might have a lot of parents that say, well, I don't want to vaccinate my kids with a new vaccine because kids don't even get sick from this barely. You might actually have to vaccinate the elderly or most vulnerable people in the population, and those are the people that are most vulnerable to a vaccine. Any event, all of that to say, you've seen a big bounce in markets off of the lows in March. That obviously feels good. Our medium-term outlook, our long-term outlook is very positive. We think, there will be a day on the other side of this virus where things will return back to normal. However, we are prepared for it taking, I don't know if it's necessarily 24 months, but for it to take a little while for us to get to that stage 4 that Frank referenced. And if you look at the right side of this page, there's kind of good news and bad news in terms of confirmed cases and fatalities. The good news is obviously that we've peaked and these lines are trending lower, albeit pretty slowly. The bad news is, the really drastic measures that we've all taken they've moved these lines down, but they're really kind of just flattening out a little bit. And we're stuck at around 30,000 cases a day, and something less than 2,000 deaths. And we wonder what these are going to look like, a month from now or 2 months from now, as we start to open things up. And as Frank mentioned, there's just so much uncertainty right now. That's one of the reasons that markets have been really volatile, and we just don't have these answers. Our view is, we're going to settle into figuring out a way to operate in this kind of new world for a while, in which we think we're going to be in this world for a little while, and that things will slowly start to thaw out as we move from phases 2 and phases 3. We think it's going to be a slow process, over the next probably 12 to 24 months. So this slide shows the areas of the economy that are really hardest hit by social distancing. And it really, which should come as no surprise, it's retail businesses, it's food and beverage, entertainment, and travel, essentially. And the left side of the page really frames why this has been such a big deal for, one, employment, and two, for our economy. Just these sectors represent about 20% of jobs in our economy. And that's why, we're going to get an unemployment number on Friday. Our guess is we're going to have 16% unemployment as of this Friday. We'll see. Maybe it's a little better, maybe it's a little worse. It probably will get worse from there. And a lot of those people, not all of them, but a lot of them are coming from these areas of the economy. One of the things that's really worth watching is actually, there's a lot of time you could spend on this particularly. One of them is, are you going to see widespread layoffs in other areas of the economy? And our base case is no, and that's certainly what the government is hoping with all these programs. They're really hoping to stop, unemployment for spreading to other areas. Think JP Morgan. Does JP Morgan have a bunch of layoffs? I sure hope not. But I don't know. But what these government programs are really designed to do, we'll get to in a moment, is hopefully to prevent layoffs in most industries outside of these that are really on the front line. Another point on this is, because of the expansion of unemployment benefits, a lot of these people that are losing their jobs are actually right now collecting more from unemployment than they would have from their job. And that's both good and bad. It's good in that these people shouldn't be, a lot of them should not be in a worse financial position, although, you can't gloss over the stress of losing your job, but at least hopefully they're still able to pay their bills. They can keep paying their car loan. They can keep paying their rent. And a lot of that prevents, the spiral down and the second and third derivative effects of all of this. But the other thing is, you might find some businesses that have trouble getting people back off the sidelines. If they were making $1,000 a week, and their old job calls them and says they want them to come in and go back to making $700 a week, but also be at risk, it will be interesting to see if that actually happens. But over a short period of time, you may have a push and pull where some people are really incentivized to stay at home and take this check, which is more than they were getting working. But that'll be something to watch in the coming weeks and months. The last comment I'll make on this page is just that so these sectors are 20% of jobs. They're also 19% of the economy, if you look at the top left. So it's obviously a big part of our economy. Our GDP was negative in Q1. Frank, I think you can take the likely out of there. GDP growth is going to be negative in Q2, one of the worst quarters we probably will have ever seen in our lifetimes, hopefully. Maybe 20%, 25% contraction in GDP. The good news is things will start to get better from there as we move into the different phases that Frank mentioned. I want to talk just a little bit about what the Federal Reserve has done and what also the government has done really to try to ameliorate some of the issues we're going through. And first, the Federal Reserve has done a couple of different things. First, and most notably, if you look at that squiggly line across the page, the Federal Reserve has moved interest rates back down to zero. That's the Fed funds rate, very short-term interest rate that the Federal Reserve controls. We had interest rates at zero for years coming out of the financial crisis. They took interest rates back down to zero with the goal of hoping to stimulate demand and activity. Fortunately, when people are sitting indoors and not doing anything, that's not really going to do much to stimulate the economy at this point. And then really more of the heavy work is going to fall on the government and the fiscal packages and the CARES Act, which I'm going to get to in a second. But the other thing the Fed did, and if you look at that box with all those different line items, the Fed put in place a bunch of different facilities, all with the goal of trying to prevent a financial crisis. And so we are facing a healthcare crisis that has become an economic crisis. And the Fed wanted to prevent this from also becoming a financial crisis. And in March, I don't want to say we were on the brink of a financial crisis, but you had massive dislocation in areas of the market that you don't typically see dislocation. Think about on the bond side, high quality government bonds and things. Things were moving all over the place, which is really abnormal. The Fed took a bunch of steps, put in place a bunch of facilities that has really calmed that down. So a lot of what they've tried to do has worked. We have avoided, a widespread financial crisis. We think that the worst of all of that is behind us, and the Fed has really done what they can. If we turn to the next page, we can talk about just a little bit about the CARES package. There's too much on this page, and it's a topic you could spend hours on, and I promise I won't do that. But if you look at the bottom left side of the page, you see a really big number, $2.4 trillion. To date, that's the extent of the fiscal response from our government. That is more than 3 times larger than the response to the financial crisis, just to put it in perspective. So the size and the scale of the responses from both the Fed and our government are truly off the chart. And that's one of the reasons that you should be pretty optimistic about risk assets, about stocks, over the, let's call it medium term. I mean, all of this stuff, it can't fix the virus. But man, when the virus is in the rearview mirror, there's a bunch of shots in the arm here that are going to really boost the economy, at least over the short term. Longer term, as Frank mentioned, we're going to have higher deficits and higher debt levels to deal with. That truly is a problem for another day. All the measures that are shown on the left side of the page, which are basically focused in 2 areas. The first 2 line items there are for individuals, so direct mailing out checks and also expanding unemployment benefits. And the next couple line items are all to help businesses, small, medium, large-sized businesses, both through loans and forgivable loans, which are essentially grants, as long as companies meet specific guidelines. All of that is designed to really try to freeze the economy in place so that when we get to a better place, when we're at phases 3 and 4, we're able to really bounce back quickly. And our view is that we're going to have, we're calling it a U-shaped recovery. You might hear a lot of letters, people talk about a V-shaped recovery or a U or a W or an L. What we mean by U is kind of straight down and then bounce along the bottom for a little while and then almost a straight up. That's not typically the way the recessions go. Usually you have long lingering pain. Think about after the financial crisis, where the ramp up takes several years. Our base case is that because of all this stimulus, once we get to a better place, that we're going to have a ramp up, unlike we've seen historically in recessions in the past. Talk about just a couple of thoughts on stocks and bonds and investing principles in this environment. And this page is really just a reminder that stocks are volatile, and at this point, none of you need that reminder because we've lived it over the last 6 weeks or so. But maybe this helps put what we've seen recently into perspective. What we show first are the gray bars are market returns for the S&P 500, the largest 500 stocks, listed stocks in the U.S. And up is good and down is bad, and we give you a number that gives you the magnitude of the return for the year. And then we show a red dot, and that red dot is the biggest drawdown at any one point during the year. If you look at the top left, you see some language. It's hard to see, it's pretty small, but you might see a 13.8. The average drawdown in a given year over the last 40 years is about 14%. That's never going to feel like average. So you have, $100,000 becomes $86,000, and that's in an average year. But that's what markets do. And if you look at the right side of the page, you see a negative 34. So we had a drawdown in the S&P of 34%. That is, it's not normal because your average decline is about 14. However, if you look across that page over the last 40 years, you see a bunch of data points that, down more than 25%. So it's certainly not normal. However, it's not unprecedented. And if you're going to invest in equity markets over a period of 10 or 20 years, you would expect to have the declines of that magnitude, unfortunately. The good news is that, this is as of the close yesterday, the S&P 500 is now down 12%, and we got back another 1% or so today. So as of today, you're down about 11%. We cannot with any confidence say that there's not going to be any more downside, or that we won't go down anymore from here, because we just can't predict the future. However, it's certainly not our base case that we're going to go back down to negative 34% again. I would say it's possible, but it's not our base case. And this slide just really puts into perspective that unfortunately volatility is normal. And if you look at the next page, so this is the same. This is a busy slide. There's a lot on it. There it is. But it shows the same data we were just looking at, returns and drawdowns for stocks. But now we're also showing a 50-50 portfolio. 50-50 meaning half stocks and half bonds. And that may be at least more representative of what the average person actually owns in their portfolio. And this is not meant to be a benchmark for how your portfolio has performed. Really, to give you another data point, now if you look, the max drawdown of a kind of a rough 50-50 portfolio was something like 18%, not 34%. And at this point, that portfolio is likely down single digits. It's not down 12%. And oh, by the way, if you just look at the bars for last year, the 50-50 portfolio was up, high teens or so. And so hopefully that kind of puts all this volatility in perspective. It's certainly not fun to see drawdowns in your equity portfolio and your portfolios at large. But at this point, a diversified portfolio is down in the single digits. Not a terrible result given all that we're facing. And we can understand why markets are where they are, because everyone's anticipating a rapid bounce back when we get to a slightly better place. This one shows, we all know stock markets are volatile. The problem is that volatility causes emotion, and emotion is the enemy of investors. And that's what the chart at the bottom of this page shows. First of all, we're showing 20-year returns. That's what all those bars are. Over the last 20 years, if you look at the green bar, that's the returns of stocks. Stocks have been up about 6% over the last 20 years, which actually historically is a lousy return for a 20-year period. But it's because we had both the financial crisis and the tech bubble over that 20 years. But stocks were up 6%. Bonds were up 5%, if you look right in the middle of that page. So a portfolio of stocks and bonds, which is what most people own, should have been up somewhere between 5 and 6%. However, if you look at the orange bar near the right side of the page, this group that puts this data together calculated that the average investor actually returned 2.5% over the last 20 years. And it's almost like a brain teaser. If people own stocks and bonds are up 5 or 6, how do you end up at 2.5? And the answer goes back to the last slide. It's the volatility. It's people getting out of the market at the wrong time because of the raw emotion of seeing the losses and feeling the pain, and just the fear of the unknown of what's in front of us. I mean, Frank mentioned it. We don't know what the next handful of months or even a handful of quarters are going to look like. But that doesn't mean you sell all your stocks and move to the sidelines, because when you do, you end up with that orange bar. You end up with a really bad result. So times like this doesn't mean you don't make any changes in portfolios, but it doesn't mean you get out of the market just because things are scary. That's a really bad approach. And historically, people that are the average investor, the people that aren't working with somebody like Frank, make bad decisions, and they end up with returns a lot worse than what they were really entitled to based on the risk that they were taking. This chart just speaks to trying to time the market. We manage portfolios in-house, and we make changes all the time. And our changes are usually think about a dimmer switch and not a light switch. Turning, a little bit one way, a little bit the other way, sometimes more than a little bit. But it's rarely all in and rarely all out, because you can make big mistakes that way. And trying to get entirely in or entirely out of the market is really, really difficult to do, and that's what this chart shows. If you look at the bar on the left side of the page, that shows that over the last 20 years, stocks have returned 4.5%. Now, there's a different number than we saw on the last page because it doesn't include dividends. Let's just use that number of 4.5% over the last 20 years if you were fully invested. Now, that's about 4,000 trading days. If you missed just the 10 worst days, you went from up 4.5 you lost 4%. If you miss just the 20 best days, you're now at negative 2% from up 4.5%. That's 20 days out of 4,000 days. So you cannot afford to miss a handful of best days of returns. It is going to massively eat into your total return. The kicker of the slide, and while it's difficult, it's not impossible to really time the market, is that if you look at that white box in the middle of the page, 8 of the 10 best days occurred within 2 weeks of the worst days. And we've lived this over the last month or so. We've seen several of the best days ever for the Dow and the S&P 500, but we've also seen a handful of the worst days ever. And even if you had a crystal ball that was able to get you out in front of the bad days, you would miss the good days as well. This chart shows you that's going to put you in a really, really bad place.
I shared this slide with you last week, and I want to spend a few more minutes on it because I wanted to point out the challenges I think that we're facing here as we go through the next probably 6 months. The volatility that I think we're going to experience, and I agree, I heard Brian say it, I've certainly said it a couple of sessions as well, that I don't know that we're going to retest those March 23rd lows again, but I think it's very reasonable to expect that we're going to have some negative numbers here, some volatility that's going to go down and get near that. It may not hit the 34%, it may only hit 30 or 25, but it's unreasonable to think that with all of these areas, this is worldwide supply chain disruption. If we continue to have problems with supply chain, that's going to have some problems. Here's tax decline payments for taxes for state and local and federal government. This is going to be a problem for them. Negative effects of wealth. So far, the focus has been on the illness itself, not on the finances, the economy. And I'm talking about not just you, but because you're very engaged, but there's a lot of people that aren't focused on this right now. They're just focused on how they can get back out and start living life and wondering what that looks like. So in reality, these are various areas where we're going to probably see some volatility over the next few months. It's not going to be bad. It's just part of what we got to stay on top of. And Brian showed it from a different viewpoint. I'm going to go ahead and hit this slide again where we talk about here's Q2, what we expect to see GDP growth look like. Then we move into Q3, then Q4 should move back into positive territory again, which should then just ramp up into 2021, which is what we're looking for. So the markets we're watching back in here somewhere ready for this moment, but it's still going to, especially in an election year, have some reactions as we have a number of different pieces of information, whether it's unemployment, it's quarterly earnings for corporations, it's shrinkage of GDP growth. All these things are going to feed back into this concern, which will then probably create that volatility, which is a more opportunity for those of you who have cash and are ready to get back in. When we get to that place, that's going to be an opportunity. Again, you'll notice on here, we're showing the recession of 2008. And there was some great material that Brian showed in his slides. We don't have a gray bar here. I'll be curious to see how that gray bar looks in this area. But we should see that while we won't get back to the trend, the forecast is we're going to move back in that direction again with real GDP growth. I shared this last time about how debt, which is what we were operating with before COVID took over, how it has a positive impact on asset prices, jobs growth, investment growth, expectation of return, et cetera. But it also has a negative impact when it goes in reverse. And so I know that many of you have talked with me about your concerns regarding the debt, and I know I've got a couple of phone calls with a few of you this week about that. I don't know if you had a chance to go check the U.S. debt clock, but you should, just at least to stay on top of it. I shared with you last week about how this is what debt was. As a matter of fact, one of the charts that Brian showed was this exact calculate or this exact information. This is back during World War II, and we're approaching that now. To drill down a little bit on that in the remaining minutes we've got left, wanted to share with you some of the thoughts because I know this is an issue that many of you are concerned about. So here's some of the facts. Right now, most creditors don't worry until sovereign debt is more than 77% of GDP, according to the World Bank. Most creditors, nation states, don't worry until we cross that 77% mark. In the first quarter of 2020, the U.S. debt to GDP ratio was 110%. So that means they should be concerned, but they're not yet. Part of the reason they're not is a couple of facts. One is that the 23.7 trillion U.S. debt as of March 31st divided by the 21.5 trillion nominal GDP, while that's what creates that number, around 17.7 trillion of this debt is public debt. That's what the government owes to investors, including 1.6 trillion owed to China. Now, that debt is debt that they are looking at, and they're saying, okay, so you've got to pay these people back. 30% of that debt is to foreign nations. So that's another aspect here. So the 17.7 trillion, of which 1.6 of it's owed to China. The reason I point that out is that you already heard the president comment that maybe that's how we would get some of our money back. I don't know if that's what's going to happen or not. I'm not suggesting it is. I'm suggesting, though, that when you look at debt and you recognize that $24 trillion number that's so huge, when you take it back to public debt, you realize it's not quite that big. When you take a look at foreign nations, it changes that a bit. Now, how will that work out? I don't know. None of us know. But if you go to the next line, though, I think that's what's kind of interesting about debt. Another $6 trillion is debt the government owes to itself. That's mostly the Social Security Trust Fund. Now, that's like you borrowing money from you. Granted, the government will have to deal with that one day as baby boomers retire and that number becomes more and more important. The reality, though, creditors aren't particularly worried about this component of debt yet. Now, when they become worried, that's when it'll become a problem. But will that happen this year? Will it happen 5 years from now? Will it happen a decade? Will it happen 2 decades? We don't know the answer. So when we're sitting here looking at debt and you're saying it's a terrible thing, and I agree with you, it is a terrible thing, it's important to remember that just like we looked at before, we came through it, and we came through it. If we can get the growth again, which I tend to believe we can, then it may not be quite the problem that you're concerned about. It may, though, and that's why we need to be thinking about how we would function as investors, as citizens, as living in the U.S. to handle this well. That's part of what we're going to be looking at, but I don't think it's a problem today. I think it's a problem that we'll look at as we get further down the road. Now, Brian also showed this chart too. He showed how the previous baseline versus the stimulus, and that was a great point, that this is more stimulus than we applied in 2008. This is a huge number when it comes to the stimulus we're doing, which should help make 2021 a good year, which should help make it so that when the time comes that the stock market takes off again, the economy takes off again, the stimulus will actually make that possible. But I did put this up here because I wanted to just take a quick moment to talk about this as well. 4 ways that the United States could pay off its debt if it wanted to. So one is it could cut government spending. It's probably not going to happen, though, because the problem is each party has its constituents that are counting on that money. And so to cut that requires somebody to lose money, and it requires politicians to take a stand that they're not willing to take a stand on. So chances are that's not going to be the solution. Raise taxes. Chances are that's not going to be the solution either. Now, granted, I think it will become the solution in the future, but I don't think it can become the solution in the short term. The reality is that when they raise taxes and it slows down economic growth, it is a problem. Now, can it be positive? Sure it can, as long as the net results that come back to government spending, taxation, the growth in the economy all work out well. But that's a tough act to follow, and right now we're just focused on the GDP. We're focused on the growth and the stimulus for the economy as we come out of this virus. Number three, drive economic growth at a faster rate. And quite honestly, that is what the current administration has been doing, has been working to do, has been seeking to do this whole time. When Trump came into office, his plan was to grow the economy to make it so that this GDP, which is, it's important to understand, this is a percent of debt compared to GDP. So you get enough growth, and then you can get some change in those numbers. And then finally, shift spending to areas that create the most jobs, which is another one of the solutions. So chances are what we're going to see here in the near term is a focus on these areas, not on these areas up here. How that will fit, What that'll look like as we go further down the road with the economy and the markets and such, I guess we're going to have to wait and see on that. But as of today, I don't think this is our biggest concern. I think our biggest concern is getting our economy up and running again. And as Brian's material showed, it's obvious that there's a lot of positives that can come out of this as we go forward. Again, as we come to the end of this, I know that many of you now have taken advantage of that, and I've had some great conversations with you as you've used Riskalyze to understand your risk-reward discussion, and I am really excited about some of the conversations we've had. It's been very helpful for me to understand what you're thinking, and I think even in some cases, some of you have understood what I was thinking when we were trying to manage portfolios for you. So again, if you've not set up your Riskalyze link, please reach out to Lorena in email and say, I'd like to do that. We'll send you a link so you can get hooked up. I told you I'd share 2 new links with you today that I'm trying to get all the clients to take advantage of. It comes back to what I shared a couple of updates ago, SMART goals. Again, if all your focus is on what are we doing right now, that's fine, but the future is out there as we set SMART goals, which are specific goals, measurable goals, assignable, define who's going to do it, realistic, state what results can realistically be achieved, and then time-related, identify a time frame for it. So there's 2 links you can have. Again, you'll email Lorena, and she will send you access to this. This is your financial life planning link, where you can go in and identify, I believe it is 52 life goals that you can identify, and you can prioritize them, high, medium, and low. And it actually helps that conversation about setting SMART goals that match what you're trying to do and help us, me, our staff, to focus on helping you focus on the high ones and not worry about the low ones, and if there's any medium ones, to kind of help you think through where they need to be. Additionally, not only can you access life goals, but there are, this is where the 63 transitions, there's various transitions that you and I will go through. As we move towards life goals, we go through changes and so on. And again, the same thing can help you prioritize these high, medium, and low as to what's important to you. And these, both life goals and life transitions, can help you identify your SMART goals as it relates to your investments, wealth management, accomplishing your life planning that you want to do, and as we've talked before in other workshops, your ROL, return on life. ROI, return on investment, is critical. That's what we've been talking about here, and that's why we're doing these updates, to help you focus or identify how you're handling ROI. But ROL is what's going to matter the most, which is when we take our last few breaths on this planet and look backwards and say, what did I accomplish? We won't be thinking about how much return we got. We're going to be thinking about what we accomplished with what we had. So again, both of those are available. If you'd like to access that, simply email Lorena at lorena@franksoffice.com, and she'll get that for you. As I've closed out the last few, I just want to remind you, and I think Brian did an excellent job of sharing that as well, that 3 years from now, CV19 will likely be a memory. Not a memory that's done. I think we're going to be stuck with it for a long time. But with that in mind, and several of the charts that Brian showed exactly what I'm putting up here. 25 bear markets and 26 bull markets since 1928 in the S&P 500. 299 days was the average length of the bear, 1,003, 3 times the number for bull markets. And those charts show that. If you saw the number of up lines versus down lines, it was obvious. 36% average loss in a bear market from peak to trough, 112% average gain in bull market from trough to peak. 23% of the time we've been in a bear market, 77% of the time we've been in a bull market. So keep that in mind. Don't let this panic you. Many of you are handling this very, very well. But as we go through these next 2 quarters or 3 quarters, there's probably going to be some other information. It's just part of the process of working through this. And hopefully from Brian's material tonight, as well as stuff we've been sharing with you, you can kind of get a better sense of that. We had a question. One of the questions was, let's see here, not sure how much the effect of small business on investment opportunities. Seems like the stock market has some level of independence from what's going on with smaller businesses. That's a great question. Brian, would you like to handle how the market compares with smaller businesses and why looking at smaller businesses may be important or may not be important? Just your opinion?
Yeah, I mean, I'll take a quick shot at it, but the biggest implication is just on the economy. It's like 50% of jobs are from what we would call small companies. You know, if all these companies are hit really, really, really hard, and we didn't have, you know, the support that's coming from the government, ultimately that would have knock-on effects, second and third derivative effects that would impact some of the larger companies that at least for right now are more isolated. And so, you know, I think it would have first an impact on unemployment and other areas that would ultimately bleed further into the economy and ultimately have a bigger impact on the S&P 500 and larger cap companies. That's really why a lot of these steps, the PPP and the different CARES package are so important, and also why the S&P is only down, you know, 11% or so year to date, given what we're facing, because it's because of that reality.
One of the things that you had talked about in our conversation previously, Brian, was the quick sell down to 34% and who actually drove that sell versus who hasn't so far participated. Remember what we were talking about as far as like the hedge funds and so on?
Yes.
Would you share that with the listeners as well?
The bulk of the marketplace it's a big thing. You never know exactly who's selling and who's buying and stuff, but JP Morgan is obviously a large firm with a lot of different lines of businesses. We deal with all different types of investment clients, all the way to, you know, institutions and sovereign wealth funds and hedge funds and, you know, you name it. We have seen that most of the selling, particularly in March, was driven by hedge funds, and there was a lot of, you know, forced selling and deleveraging and margin calls that resulted from, you know, initial drawdown in prices. We have not seen a lot of selling on the behalf of institutions, and have also not seen a lot of individuals selling. And so that's one of the questions going forward. You know, a lot of times in a drawdown like this, at some point, a lot of individuals decide they can't take the volatility anymore, and they ultimately get out of the market, which ends up being usually a bad decision. And there's one thought internally is that could potentially be the next leg down in the market. If a bunch of individuals who so far have stayed invested, you see a little more volatility and they decide, you know what, I can't take it anymore, get me out. Potentially that's a source of volatility, but at least for right now, most people have stayed invested, I think, because they're able to see what's going on. They see there's a light at the end of the tunnel, but that we're going to have some volatility ahead of us most likely. But to your point, you know, 3 years from now, this will be a memory. So why should I get out now?
Yeah. One of the items we talked about in, I think, our first or second update, one of our resources showed us they broke up recessions into four quarters. So like the average recession was 15 months. But if you think of it as like a 12 months, that's not the average, but if we say 12 months, that would mean the first 3 months, the second 3 months, the third 3 months, and the fourth 3 months. And kind of what you just described, they identified that in the first quarter of the recession, the markets lost about 28% of its total loss. So in essence, if it went down 10%, that was what the total loss was going to be, 28% of that 10 was happening in that first quarter. And then the next 2 quarters were about 13% each. And then the bulk of it, almost 50%, happened in the fourth quarter of the recession, the last 25% of the recession, because of what you just described, capitulation. People just sort of give up. They go from having hope to despair. And I think, you know, you had talked earlier about how you believe it's a U-shaped recovery. I think the same thing, although I kind of wonder if we might see a little bit of a W as we go into the summer. But still, that capitulation and all the negative information, I wonder how that's going to look here when we get into the summer and the fall. I'm not asking you to answer. If you want to answer, you certainly have. I'd be glad to hear your thoughts. But I think that's part of what I'm kind of wondering before we get to the upside of the U, maybe in the summer or the early fall, we might see that place where everybody's like, I can't take it anymore. It's just been too long. And then they're ready to go. Otherwise, we just stay where we are and we kind of hold through the summer and then all of a sudden take off after that. But I think at that point, as long as it's nothing terribly dramatic or crazy, I think that could be a really good time to buy back in then, or to buy in, or to take some cash, because those are going to be some great sales right then.
That's right.
Yeah. So, and I don't know if you noticed, somebody asked me to put the SMART goals back up again so they could write them down, so I did that. So it looks like that's all the questions we have today. I really do appreciate, Brian, you taking time to get on here. Is there any closing thoughts you'd like to share before we close out today?
No, I mean, I will let you close, but I really appreciate the opportunity. And if you get questions, feel free to reach out to me, tonight or tomorrow, and we're happy to get your thoughts.
Absolutely. All right. Well, as always, it's my pleasure and my honor to serve you. I know we got a couple of new people on here today, and obviously some of the regulars, and so we appreciate you all. As you can tell, we're working hard to stay on top of this, and whatever we can do to help you, I agree with Brian. If you have any questions, feel free to reach out to me. You can do it by email or phone. If you have questions for Brian, I certainly can get to Brian, and we can get you on the phone with Brian and answer questions that way as well. But again, I appreciate you taking the time to join us tonight. Brian, I appreciate you joining us as well. I did think you did a great job. And as always, take advantage of these links. We're here to serve you, and it's my honor to work with you all. So have a great evening, and as everybody's saying now, be safe, be well, and I will look forward to talking to you soon. Thank you, and we'll have another update next Tuesday night. And again, any questions you have between now and then, feel free to email them to us, and we'll make sure those get included in part of our topics. So thank you, and have a great night, everybody.